to an exclusive conversation on ICICI Direct about decoding the SBI Balanced Advantage Fund NFO. Joining us today on the show is Mr. Dinesh Balachandran, Fund Manager, SBI Mutual Funds. Thank you, Dinesh, for joining us today on the show. Dinesh, to begin with, tell us more about your NFO, the SBI Balanced Advantage Fund.
Yeah, good afternoon, Samina, and thank you so much for having me here. When I think about the SBI Balanced Advantage Fund, we think the market environment that we currently are in some sense, is very appropriate for a fund like this. Mm-hmm. Because when you think about Balanced Advantage Fund, what it is attempting to achieve, to us, there are two investor-based issues that we are trying to tackle with this fund. The first issue is this inherent human psychology where when markets are at a very attractive point, no one wants to invest, unfortunately, because they are just looking around and they just look at the doom and gloom and then they say that, you know what, I don't want to invest in markets. So if you just go back 15 months, markets were at a very attractive entry point. But I suspect very few investors would have taken the advantage of investing back then. Now, on the other hand, when we go back in time and look at 2017, for example, where markets already had a very significant bull run for several years and valuations had gone up significantly and earnings also had gone up significantly. At that point, people were suddenly got comfortable investing in equity, right? And then there was a period where that led to suboptimal returns. So there is this inherent problem where investors ideally should be doing the buy low, sell high. Mm-hmm. But normally what we find in some sense is the exact opposite, where they buy high and sometimes want to sell low when they get very frustrated with the markets. So when I think about the Balanced Advantage Fund, it really achieves or it attempts to sort of solve this problem, where the asset allocation in the Balanced Advantage Fund will be changed in a dynamic fashion, and the allocation will be changed in a counter-cyclical fashion. So this really takes care of the market timing risk that so many investors are either getting wrong or are inherently worried about, essentially.
Dinesh, the model is counter-cyclical. Can you talk to us a little bit more about how this will benefit to be counter-cyclical right now?
Yes. Yeah. Again, the underlying premise is very simple. The point is that both equities and fixed income, they essentially are going to be cyclical in nature. They are going to be volatile in nature. What you want to do is take advantage of that volatility. Mm-hmm. By that, what I mean is that when equity valuations are very low, you at that point, any investor, ideally speaking, should then increase their allocation to equity. Because when the valuations are very low, then the future returns can be pretty good. And so one would want to sort of increase allocation to equity at that point. And when valuations are very high and the margin of safety is quite low, one would want to potentially book some profits and move at least part of their allocation towards a safer investment like fixed income. And so this is what ideally someone should do, and this is what a Balanced Advantage Fund really is trying to do. That invest in a counter-cyclical manner when things look bleak, but valuations are very attractive. You get in at that point. And when things look very good and everyone is feeling like it's a party out there, you really want to sort of reduce your allocation to equity.
Dinesh, markets are trading around the new highs. How much will the equity allocation be as per the model if the portfolio has to be constructed immediately?
Yeah, that's a good question. Unlike last year, where thanks to, as I said, the very cheap valuations, the equity allocation in this fund would have been as high as 20%. Over the course of the last 12 months, that allocation has been brought down, would have been brought down steadily, where the current equity allocation, based on our framework, would be 40%. So 40% would be the equity allocation, and the remaining would be a combination of arbitrage and fixed income.
Okay. Dinesh, markets, of course, we talked about the levels already and the allocation, but how will the model indicate how much allocation should go into, say, large cap, mid cap, or small cap stocks?
Right. So this is again something where the objective framework really comes in handy, because what we are trying to do, one, as part of step one, which is the basic asset allocation step, the objective framework, which basically is a combination of valuations and sentiment, it tries to determine how much to allocate to equity and how much to allocate to fixed income. Once we do that, then the next step is within the equity allocation, we try to figure out which way should the portfolio be tilted so that we get maximum risk reward in our favor. So last year, the portfolio would have been tilted towards broader markets, would have been tilted towards small cap and mid cap stocks. Because based on our framework, large caps were at historical extremes in terms of being very expensive compared to broader markets. So at the beginning of 2020, large caps were so expensive related to other sectors that one really wanted to be in broader markets. But obviously, the last 15 months, a lot of these stocks and segments have gotten re-rated substantially. Now, small caps have re-rated to such an extent that at this point, within the equity allocation, the large cap percentage will be 75% and small and mid caps would be the remaining 25%.
Now, Dinesh, what factors differentiate the SBI Balanced Advantage Fund from other existing Balanced Advantage funds that are already in the market?
Yeah. So, one, I would like to say that when we thought about creating a product, creating a framework for this particular fund, we approach it from the perspective of what makes the most sense, rather than setting out with the objective of coming out with something necessarily which has to be different. We wanted to come out with something that really makes sense, at least from our perspective. Now, when you think about the underlying components, valuation is a common factor across most balanced advantage funds. But for us, when we talk about valuation, we made two major modifications. One, we think about relative valuations as opposed to absolute valuations. So for us, if someone says that the equity market is now trading at a PE of 25, so it's very expensive, we think that is an incomplete statement, because you have to think about what are the alternatives. Where are fixed income yields? If fixed income yields are very low, then all else being equal, equity valuations need to be quite high. So relative valuations is very important in our framework as opposed to absolute valuations. And the second major modification that we made in our product is that when we talk about valuations based on earnings, we do not want to simply look at the last 12-month earnings or the next 12-month earnings, because they inherently tend to be very noisy in nature, and they do not capture the fact that economic cycles can have their very strong up and down movements. So when we talk about valuations, we want to talk about valuations based on earnings that are average over an entire economic cycle. That's the Shiller PE that we talk about. So that way, when you're analyzing particularly cyclical sectors, doing it on a cyclically adjusted fashion makes a lot more sense than just looking at the last 12-month earnings or the next 12-month earnings. So that is a major modification from what I can see compared to what others are doing. The other differentiation factor would be that for us, the strategy tilt in terms of deciding how much to allocate to large cap stocks versus small and mid cap stocks, or how much to allocate to cyclical stocks versus defensive stocks. These are also part of our objective framework, where it's an explicit part of our decision-making process, where upfront, the framework helps us to decide what should be our allocation towards each of these segments. And then we go about picking the appropriate securities for each of these products.
Right. Dinesh, with interest rates at record lows, investors are in search of options which can deliver marginally higher but relatively stable returns. So for this FD investor, can this be an alternative avenue?
I definitely think so. The reason is very simple. One, when we thought about the framework for such a fund, we very much had risk in mind, because we know that there are many investors who are looking for alternatives to the very low FD rates that they are seeing. But they at the same time are worried about volatility. They are scared when they see significant correction in the equity markets, right? And so when we thought about this product, that was the number one thing that we had in mind in terms of how do we mitigate that risk. So the fact that our asset allocation is dynamic in nature, right, where it will act in a very nice counter-cyclical manner, that inherently improves the risk profile. Two, just a combination of having equity and fixed income, that leads to a much better risk profile compared to a 100% equity. So when you put it all together, the endeavor is to come out with returns that are quite attractive compared to fixed deposits, I wouldn't say that there is no downside risk in this product. That's not true. There is downside risk in any such fund. Right. But clearly, from a quantum perspective, the downside risk potential in such a fund is going to be much lower compared to a normal, hybrid fund, the erstwhile balanced fund category, as well as a 100% equity fund. So the risk profile is definitely going to be much better, which should give comfort to a lot of investors who are thinking about taking money out of FD in search of better alternatives.
Would this product offering work for millennials, Dinesh, for their sort of goals, which is a dream car, potentially a dream vacation?
Yes. Yeah. Again, anyone who is thinking about long-term wealth generation, with the keyword here being long-term, because that is what helps you really achieve some of these goals. Such a fund will be very appropriate, because when we think about equity as an asset class gives you one of the highest probabilities of meeting your wealth-related goals, right? So even in this product, when the situation so dictates, we would have high allocation to equity. And that essentially helps us generate returns, which are going to be quite attractive, and which, when you think about the compounding factor, over time, the wealth corpus sort of builds up enough for investors to achieve their wealth-related goals, whatever they may be.
Dinesh, so would it be fair to assume that this fund is only for a conservative investor?
I honestly believe that this, in some sense, is one of those products where it can sort of cater to a multitude of investors. Because when you think about what we are trying to achieve here, we are saying that we will endeavor to create long-term wealth, which is the aspiration for most investors. Yeah. We are also saying that, but we will be mindful of risk. We want to protect downside risk to the extent possible, which inherently appeals to the conservative investor base. But to the extent, if the asset allocation is, the change in the asset allocation is done in the right manner, is done in a calculated, methodical manner, it inherently is going to appeal to almost all investors, barring certain investors who are so comfortable taking on risk. There is a very small minority. For them, it obviously makes sense to go for sort of 100% equity oriented funds. But I would say for the majority of the investor base, this really can be a core part of their overall portfolio.
Awesome. Dinesh, also, can this fund be an appropriate investment for building a retirement corpus?
Definitely. As I said, because the endeavor is to sort of do long-term capital appreciation. And when we did the backtesting for our framework, what we found was that over the last 16 odd years for which we did the backtesting, the returns on this fund or for this framework were very attractive, even compared to Nifty index. So from a longer term perspective, the returns that one can generate from this fund should be attractive enough that if someone starts early, by the time they approach retirement, that corpus, logically speaking, should be like pretty.
Right. Very lastly, Dinesh, what do you advise investors to do? A lump sum investment or a staggered investment? What is your suggestion?
In a fund like this, where the basic premise is to sort of do dynamic asset allocation, where we are saying that we will do dynamic asset allocation in a nice counter-cyclical manner, it really makes sense to do lump sum investment, because that way you essentially put that money in and let us deal with the issue of how do we sort of rebalance, how do we essentially take advantage of market volatility. So definitely for a fund like this, rest assured, we will actually take advantage of market volatility for generating better risk adjustment.
Right. Thank you very much for that, Dinesh. It was great talking to you and getting an understanding of the SBI Balanced Advantage Fund NFO.
Yeah, thank you so much for having me here.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.